All right, let's get right into it. Today, we're doing a deep dive into the massive new complexities around renewable energy incentives. You see, a recent collision between two major pieces of legislation has created a really challenging maze for the 2025 tax year, and we're going to break down the technical details you absolutely need to know to get through it. So, here's our game plan. First, we're going to unpack the legislative tug-of-war between the Inflation Reduction Act and the brand new One Big Beautiful Bill Act. Then we'll get technical with a deep dive into the Section 45W commercial vehicle credit. From there, we'll explore the wild west of the transfer market under Section 6418, tackle the real-world software glitches that are driving professionals crazy, and finally, expose some nasty state tax traps that can flip your tax-free income into a huge liability. Okay, first things first. To understand any of this, you have to grasp the core conflict at play. This entire compliance mess really boils down to two completely different philosophies on energy policy smashing into each other. And this slide just lays it out perfectly. You've got the IRA from 2022, which was really the carrot, right? It was all about growth, giving everyone long-term certainty, and, most importantly for us today, creating new ways to get cash for these credits with direct pay under Section 6417 and transferability under Section 6418. But then, bam, in July 2025, the OBBBA comes in and it's the stick. It doesn't get rid of transferability, but man, it puts the squeeze on everything, introducing these super aggressive limits and brand new, sharp-toothed anti-abuse rules. Now, what's so fascinating here is how this timeline creates what's being called a compliance compression. Think about it. In 2022, the IRA opens the floodgates. Then, boom, July 4th, 2025, the OBBBA slams on the brakes. This creates these incredibly urgent deadlines, like the September 30th cutoff to even acquire a vehicle for the Section 45W credit. It's forcing everyone to apply the IRA's monetization rules to these new OBBBA restricted assets, all within the 2025 tax year. It's a perfect storm. Okay, so let's see how this all plays out in the real world. We're going to zoom in on one of the credits that's been hit the hardest, the Section 45W Qualified Commercial Clean Vehicle Credit. So, Section 45W, it's a general business credit. You claim it under Section 38, and it's been a total workhorse for businesses trying to electrify their fleets. But here's the kicker. The OBBBA didn't just shorten its lifespan. No, it changed the entire game. It shifted the qualifying event from the day a vehicle is placed in service to the day it's acquired. And for these rules, that means the day you sign a binding contract. That is a huge technical change. Now, calculating the credit, you've got to be precise. It's always the lesser of two numbers. First, you've got the statutory percentage. That's 30% of the vehicle's cost basis if it's fully electric. But second, and this is the one the IRS is watching, is the incremental cost. That's the extra amount you paid for the clean vehicle compared to a similar gas-powered one. Let me tell you, this calculation is a massive red flag for audits, so your documentation on comparable vehicle pricing has to be rock solid. And if that wasn't enough, there are hard caps. It doesn't matter how high your cost basis or incremental cost goes. The credit maxes out at $7,500 for lighter vehicles and $40,000 for the heavier ones. Those are absolute unmovable ceilings. So how do you actually get the money? This is not some simple rebate you get at the dealership. The process, all laid out in Section 6418, is a multi-step journey. You have to first get the vehicle. Then you have to go to the IRS portal and register its specific VIN to get a pre-filing registration number. Only then can you choose to transfer the credit and report the whole thing on Form 3800. This creates a serious cash flow lag between buying the truck and seeing the tax benefit, and businesses have to model that out. All right, let's pull back and look at the whole transfer market under Section 6418. It's a game changer for getting cash, but the OBBBA slipped in a nasty little poison pill that sellers have to watch out for. The rules of the road for these transfers are super strict. The buyer has to pay in cash. That cash for the seller is federally tax-free, which is just a huge departure from how things normally work. The buyer, for their part, can't deduct what they paid. And this is a big one. Once you buy a credit, you can't turn around and sell it again. It's a one-time deal. But remember that tax-free part? Well, that's only at the federal level. We're going to come back to that. And this right here, this is the gatekeeper, the IRS's Energy Credits online portal. Every single thing that generates a credit, from a 10-story wind turbine down to a single electric van, has to be registered here first. If you don't have a valid registration number from this system, your transfer is dead on arrival. It's just not valid. So, about that poison pill. The biggest change from the OBBBA was this new rule. You cannot transfer credits to something called a specified foreign entity, or SFE. And this creates the #1 due diligence question in the entire market today. Who in the world counts as an SFE? The definition is incredibly specific. An entity gets tagged as an SFE if a foreign entity of concern, and we're talking about entities linked to China, Russia, North Korea, or Iran, hits any one of these tripwires, holding 25% or more of the equity, having the power to put people on the board or in the C-suite, or holding 15% or more of the company's debt. And get this, the entire responsibility to figure this out falls on the person selling the credit, not the buyer and not the IRS. And the penalty for messing this up is brutal. If you accidentally sell to an SFE, the whole deal is voided, like it never happened. But it gets worse. The seller, not the buyer, gets hit with something called an excessive credit transfer tax, which is the full amount of the credit you tried to sell, plus another 20% penalty on top. This is why it's now absolutely critical for sellers to write demands for beneficial ownership information right into their transfer agreements. Okay, so we've talked about the law. Now let's talk about what happens when these complex rules hit the real world. And we're going to start with a massive, massive headache. Tax software just isn't working right. I mean, this quote from a TurboTax user says it all. This person has a simple credit for a van they bought for their business. They're not trying to sell it or transfer it. And the software is demanding a registration number and literally won't let them file their tax return without it. So here's the crazy part. If you look at the actual IRS instructions for Form 3800, they're crystal clear. You only need that registration number if you're making an election to transfer under Section 6418 or get elective pay under 6417. That's it. For just using the credit yourself, you don't need it on the form. But the software has this validation bug that incorrectly flags the field as mandatory for any credit, no matter what, so it just stops you cold. And this isn't just a minor annoyance. This bug triggers these form not ready errors that can last well into February or even March. It creates a huge bottleneck. Think about partners and S-Corp shareholders. They can't file their own 1040s until they get their K-1s from their business, but the business can't file because it's stuck on this Form 3800 software error. And for our last piece, we need to talk about what might be the sneakiest risk of them all, the state tax conformity trap. What's so wild about this is the night and day difference between states. You've got states like New York and Illinois with rolling conformity. They just automatically follow the federal rules. So there, the cash from a credit sale is tax-free. Awesome. But then you've got fixed conformity states like Texas and California. Their tax codes are frozen in time based on the IRS code from years ago, long before Section 6418 even existed. And in those states, that federal tax exemption just, poof, disappears. The money is fully taxable. And this right here is how the trap gets sprung. It's on the Schedule K-1. A partnership does everything right. It sells a credit and reports the cash in Box 15 with code BC, which correctly labels it as tax-exempt income for federal purposes. But for a partner who lives in California, that label is totally wrong, and dangerously so. This means if you're a partner in California, you have to manually fix this. You get your K-1, you see that tax-exempt income, but you have to know that California doesn't follow that rule. So you have to go into your state return, onto Schedule CA 540, and reclassify that money as taxable income. If you just trust the software to do this for you, you're going to underreport your state income and could be facing some serious penalties. So that really leaves us with one big question. When you look at this landscape, expiring credits, foreign entity poison pills, broken software, and states that are completely out of sync, is your process really ready for 2025? Because in this new environment, a casual approach to tax compliance is over. A much, much higher level of due diligence isn't just a good idea anymore. It's absolutely essential for survival.